Hi, I'm Ben Solomon. The purpose of this presentation is for you, the viewer, to reach out to your senators and House representatives to get them to enact HELSIS. HELSIS stands for Home Equity Line Self-Insured Servicing. This presentation is about the purpose of HELSIS. I am the inventor of HELSIS, and I've put down more than 10 years of working in loss analysis, or today it's called stress testing in securitized mortgages, commercial real estate securitized mortgages. I've done some work in residential mortgages. So sometimes borrowers need help. There are millions, especially as of January 2021, Consumer Protection Financial Board stated that there were 2.7 million borrowers, home loan borrowers, mortgage borrowers who have problems with making their payments. HELSIS is a new hybrid mortgage which is intended to provide temporary cash flow um, to cover those periods of what is today known as forbearance. And thereby giving homeowners time and assurance that they will be able to clear this period of difficulty. What is HELSIS? As HELSIS stands for Home Equity Line for Self-Insured Servicing. What? A temporary source of cash. Why? To maintain the borrower's contractual debt service requirements. When the borrower becomes delinquent or because he or she does not have sufficient income. For example, when a recession hits, people get laid off. How? By guaranteeing those cash payments against the excess collateral of the property he has purchased. Historically, what I've seen is that uh, current financial regulations, especially concerning mortgages, have been designed for good times. That means you lose a job, you have some weeks to run around, get another job, and then you're back up again paying your mortgage. But that's in good times. That's why the law requires 90 days. In bad times, you can lose your job and you will not get it for 1.5 years. So what happens then? Banks get flooded with foreclosures. Banks don't want your money. Sorry. Banks don't want your property. They want the interest that comes out of you borrowing money to buy your property. So here you can see that this is your property value. It's at 100%. It's all done in percentages. Your mortgage is almost always 80%. Okay, there are a few things that are higher. And then we have on top of that mortgage sits the HELSIS. It's a hybrid of a HELOC and a reverse mortgage. So uh, when defaulters are unable to pay, that means they have been delinquent in your payments for a few months, HELOC steps in and makes those payments based on the excess collateral that the borrower has in his property. And then when the uh, when the borrower's situation recovers, he or she can get back to paying the original mortgage and pay off the HELSIS. So the benefits are, we'll show this calculation. I'll explain this calculation in a few slides. When a borrower defaults, they usually on average lose 15.5% of the property value of the original property value. This is the interest payments they have made. Banks, on the other hand, reduce their capital requirements, and the calculations are about 34%, less than 34% for home mortgages. Let me rephrase that. Their capital requirements are reduced to less than 34% of the home mortgages, and their capital requirements for commercial property mortgages is reduced to less than 58%. Bondholders in this US economy, the mortgages are securitized, and so bondholders will almost never see the defaults. So how does it work? So here you have in this top right-hand corner, you have a typical California mortgage. It's about 800,000 down payment on an 80% LTV, loan to value ratio. The down payment is 20%, and a typical interest rate being paid right now is 3.19%. So the loan is for 640,000. Terms as 30-year. We'll assume it's a 30-year fixed rate. The front-end debt-to-income ratio, that means how much are you going to pay for the loan versus how much you are earning. That the banks look at 29.5%, maybe 31% at the most as a requirement. And for this type of loans, the $640,000 loan for 30 years at an interest rate of 3.19, the payment is $2,765 a month. And then if you look at the impact of HELSIS, so you can set up the HELSIS so that it pays 6 months of your monthly payments, or your regular mortgage monthly payments, or 12 months, or 18 or 24 months. And that's the dollar value of the total amount of loan that you would require in terms of the HELSIS. And as a percentage of the original property value, it varies between 2.59% and 10.37%. So you can say the HELSIS will be between 2 to 11%. And these are, if we assume that the HELSIS is implemented as a 7-year fixed mortgage, then those this column here are the monthly payments between $200 and $900 a month, depending on how much it is. And the front end DTI, debt to income ratio, given you now have an HELSIS that's active. I'll explain a little bit more details. Your DTI rises to 31 to almost 32% to 39%. So those are decisions, you can see that those are decisions that banks need to look at when they are determining the size of your HELSIS. How many months of mortgage do you want to cover? Mortgage payments do you want to cover? Okay, so now we have a brief introduction into what a HELSIS is. We'll get into the rest of the presentation, which is divided into 5 parts. Capital formation, we have to look at the big picture. Why do people take out mortgages to purchase assets? Why not save the money and pay it one time? So primarily it's because homes as an asset is too large for most people to purchase right now. So the whole idea is you borrow from your future income to pay for your asset value today. That means you make installment payments every month into the future up to 30 years uh, to pay for the title of that asset. Okay, so we look at capital formation. The big picture is, why do we do it this way? Capitalism. I know a lot of people don't like that word, but let's face it, America is a capitalist country, and a political definition of capitalism is the formation of capital by an entity. An entity can be a company or a person. Capital formation for a person is savings, and usually for Americans, that savings is your home ownership. For companies, if you look at the financial statements, it's what is in your retained earnings line. So therefore, since now we have this capital formation, we can now say wealth destruction happens when capital formation, the rate of capital formation is less than inflation, and wealth creation happens when the rate of capital formation is greater than inflation, because the future value of money always goes down with inflation. So what you can purchase with 90 cents today, you need $1 to purchase that same thing 1 year down the road. That is inflation. And that is why when you acquire assets, when you are trying to build your wealth, you have to do it at a rate that's faster than inflation for your wealth to creation to be positive. Okay. So if you look at mortgage payments, in this example, you can see here I've drawn the graph using the mortgage formula. So that's your down payment that you put down for your house. And this is the cumulative sum of your monthly payments, the 2,700 that I mentioned earlier. And this gray line is your interest payments, the cumulative interest payments. And the orange dash line is the cumulative principal payments. So when you subsequently sell your property, your wealth creation happens when the sale price of the house is greater than the total amount of money you have put in. Wealth destruction happens when the price of your house on resale is less than the total amount of money you have put in. So, wealth creation, appreciated home price must be greater than the total debt service payments. The reason why this is a real and necessary perspective, because from the bank's point of view, debt service is just interest plus principal. But from the homeowner's point of view, debt service is an investment. Not only is the homeowner paying for the property value, he's paying an additional amount interest to acquire the full title of that property. Okay, some of you may argue that there are title fees and all that. No, that's not the point. The point is a homeowner cannot acquire his property if he doesn't pay interest, because he has to borrow from the bank. So he's investing his income into acquiring that property. Next point. This is about capital formation. I'm explaining why taking into account the borrower's context is very important. Defaults are expensive for the economy. Using the same data I presented slide 6, and all the numbers are presented as a percentage of the original property value. The lender's principal loss is only 0.56% because the lender only wants the principal payment back. The lender has not taken into account the loss of interest income. Okay, all the lender can do is when he gets back forecloses, he gets back his property, gets back the property, and it goes into real estate owned. He then sells the property. He or she then sells the property, and on average across the U.S., the average asset loss is 0.56%. The borrower, on the other hand, loses between 0 and 44% depending on the age of the loan when the borrower defaulted, because all that interest payment is gone. It's wasted. He cannot have any more claims on the property he was investing in. The weighted average loss of the 0 to 44% is 15.5%. So we can now look at how do societies build wealth, and this becomes very important. In economic neighborhoods, the appreciated home price is always greater than the cumulative debt service paid. That means in that neighborhood, when a house is subsequently sold, the total amount of interest paid is covered by that increase in property value. And for this data, it needs to be 1.6%, 67% per year. In uneconomic neighborhoods, why are some neighborhoods uneconomic? It's because the appreciated home price is less than the total payments, debt service payments in that neighborhood that the borrower has put in. So you can see that there are two ways of destroying wealth, which is insufficient cumulative debt service clawback, so to speak, by the home price appreciation, and the inflation rate is greater than the home price appreciation. These are the two things. When they come into effect, you have uneconomic neighborhoods. Whereas with economic neighborhoods, when the cumulative debt service is greater than the appreciated price appreciation, and it is greater than inflation, then you have a net positive creation of wealth. So this is in writing form. The text home price appreciation must be greater than net debt service payments, or another way of putting it, new home price minus old home price must be greater than the cumulative interest paid. Because the principal part you get back when you sell the property. But now we're looking at what about the interest I've invested in? Can I get that back? Yeah, anybody who's in for-profit business wants that money back. If you look at the financial statements, there's your revenue, there's your gross profit, there's your operating profit, and right below it, somewhere below it, interest paid before you come to net profit. So why are people not individuals not taking into account the interest they have paid on their profit, on their property. So, as I stated earlier, the bank's perspective of debt service is it's just interest and principal paid, whereas a homeowner's perspective is it's my investment. You look at financial statements of companies, right there, somewhere towards the bottom, before the net profit line, you have a line which says interest paid. Okay, so at an economy level, what's going on? In this slide, okay, there are three parties: the borrower, the lender or the bank, and the investor or bondholder. See, in the US today, when you take on a mortgage, the bank, once the mortgage is approved and your funds are handed off to the seller of the property, you start paying your loans, uh, you start paying your mortgage. That mortgage, the bank then sells it to an investment banker who packages a whole bunch of these loans, maybe an agency, a government agency like Fannie Mae and Freddie Mac. They package it on into a whole portfolio of mortgages, and they then tranche it into slices and sell the slices as bonds to bondholders, to investors. So there are three parties involved. The bondholder at the end is involved. So the Dodd-Frank, one of the things about Dodd-Frank, the regulation, was there's a part of the regulation that's called risk retention, and that helps govern what bondholders' risk are. So this diagram, when you have these three parties, this diagram, the top part is basically cash flow management. The bottom part is basically asset management. So not time sequence, very conceptual, high-level picture of what happens. So at the bottom part, you see the investor, the bondholder, is the primary source of funds. He passes it to the bank by buying the bonds, and the bank takes those funds and goes and issues out more loans because now they have the money to hand off to the borrower to purchase his property. And so the borrower is the primary user of funds. He uses it to pay the seller to get the property. However, on the cash flow side, the borrower is the primary source of cash flow. He is the guy who's making, or she is the guy who's making those debt service payments. He's paying principal and he's paying interest. And that is passed to the bank or whoever, or a servicer who handles those payments, collects them together, passes it to the bondholder based on the bond agreements. And the investor is the primary user of that cash flow because he wants his interest. And he wants his principal paid back, just like the banks. He wants his principal paid back and he wants the interest. With that interest is how he creates his wealth. So the borrower primary source of capital formation is the assets. And this is seen in the property value appreciation, provided the property value increases beyond a certain amount. It covers all his debt service payments. The bank, the primary source of capital formation is cash flow. They take funds from one person and redistribute it over to another person. They collect the interest from those people and pass it on to the investors. And there's a reason why they are in the middle, and I'll explain it. They perform a very important function, otherwise society will cease to exist as we know it. And then the the investor has his capital formation comes from cash flow, just like the banks. He is primarily interested in getting enough yield or interest to be able to increase the amount of capital he has. Moving to the okay, moving to the next section. Now that we have a big picture of what's happening within the economy and how borrowers um, need to be aware of what capital formation really is about, why they are buying houses. Yes, it's your home. You want sometimes, okay, I paid too much. Never mind, because it's a home I'm going to live in. Yes, fine. But if you are savvy, a little bit more savvy, then you would also want to take into account, is my capital formation positive or is my capital formation negative? So now that and then we have seen a little bit about the banks and a little bit about why and how the bondholders come into the picture. So it's not a simple, easy, I give you money, you buy the house. No, it's a little bit more complicated and a very high level conceptual view we have just seen. So now we get to part two. What are the problems in this situation? Insurance, there are three types of insurance. There's a mortgage insurance or PMI, a version of it is PMI, private mortgage insurance. It does not affect the risk to the borrower. It reduces the risk to the lender, the bank. And the other problem with that, as it stands as an industry, having gone through the Great Recession, where we saw problems with concentration risk, there are 7 major players with providing insurance like PMI. And that's too few a number. And that's why we had the Great Recession, because the backstops to preventing a meltdown did not work. The another form of protection insurance is mortgage protection insurance, which protects the borrower. In other words, for a fee, there are up to 5 insurance companies, about 5, the major players, that step in and make your payments for you, usually about 6 months, until you can get back on your feet. Okay, again, since there are about 5, this suffers from concentration risk. But the problem is, borrowers are not buying into this mortgage protection insurance. They are not. Why? Because partly, when I owned a house, I thought it was expensive. I didn't want to pay for something that was unlikely to happen. What happened? In 2010, I lost my home. I was living in Colorado. I lost my home. I learned that some form of protection was important, but it had to be much longer than 6 months. It took me about a year plus, maybe a year and a half before I got a job and I was able to make payments if I had still had that opportunity, which I did not because the bank foreclosed on it. And no matter what I did, who I talked to, I wrote off to FDIC, and a few other organizations. I talked to lots of people in different positions in the banks. There was no recourse. 90 days and get lost. That's the law. So, um, with the Wall Street crash of 2008, Timothy Geithner introduced the concept of borrow money. So, brilliant idea, and we will look at that in a short while. But effectively, mortgage insurance is of no help to the borrower. Okay, this is a result published by the Consumer Finance Protection Board, dated January 2021. And as of January 2021, 2.7 million borrowers are in forbearance, which means they have, due to the situation, the COVID-19 situation, the government has required that banks hold off the foreclosure. And of this, and they have a breakdown. CFPB has given a breakdown: 2.7 million in forbearance. UPB is unpaid balance of loans in forbearance is 548 billion, and the share of the loans in forbearance is 5.2 out of 53 million loans. And the numbers are, okay, UPB, not UPB, CFPB says there are about 53 million loans. I looked up another source and they said there were 56.1 million borrowers. So the numbers are close, but it changes with where you got it or who you got it from. But the real problem is there is a demand for forbearance, a real demand. It's 5%. Okay. The second problem that I see is that when a borrower defaults, there is no servicer. Okay, let's step back. A servicer is a person who manages payments for securitized mortgages. So when all the money comes in to the servicer, in commercial mortgage-backed securities, that servicer is called a master servicer. All that money comes in, and then they look at, okay, I need to pay that bond. Okay, here's so much. That bond, here's so much. That bond, here's so much, and so forth, and so forth, and so forth. There's somebody doing that. Conceptually, there's somebody doing that. But when some of the mortgages default and that money doesn't come in, the master servicer hands it off to a special servicer, a person who will deal with the defaulted mortgages. Sometimes that special servicer will pay ahead with the expectation that the borrower may be able to come back, cure, the term's cure, come back and continue making his payments. But the special servicer doesn't have to worry, because if the property is foreclosed, he gets paid what he has paid upfront. So the special servicer manages loans and sometimes makes payments. So you see the diagram here, diagrammatically, the payments are go from the borrower to the master servicer, maybe through the bank because you're paying the bank, and then the bank passes it to the special master servicer, and then to the bondholders. And if they're delinquent, then the special servicer steps in and may or may not make payments, but he follows up and makes sure that uh, the the defaulted mortgages are handled correctly according to the various contracts in place when the bonds were created and the relationship with the banks. Okay. Now, if you look at the banks, they have net charge-offs. The FDIC reported that the US banks charged off 0.56%, which is $120 billion they wrote off in 2020. The other thing that Bank of International Settlements has published a working paper, I think was pretty recent, I forget the year, that says that the current internal rating-based models that the banks use, IRB stands for internal rating-based models, is wanting. It needs a lot of improvement. Okay, and so internal rating-based models are to determine, when you have all these mortgages, how much capital should the bank put aside, risk capital, so that in the case of a meltdown or some serious economic issues, that the bank has enough money as cushion sitting as uh, risk capital to use to resolve those failings, defaults. And you can see in the Great Recession, it peaked here, but it's on average, weighted average is slightly over 0.5%, which for the US translates into 120 billion. So if we could reduce that charge-off rate by even half, that's 60 billion freed up for more productive use. It'll be easier, most probably it'll be easier for people to get loans. The banks can think of how more productive they can be and reach out and grow. Economic growth is substantially funded by debt. So the more you have cash available to lend to people to grow their business, the faster the economy grows. So what we need is something that will reduce this capital requirements. Why? Because it's sitting there unproductive. Okay. So the next step, part 3, HELSIS as a solution. Okay. So when we look at CFPB, they examined the 2.7 million forbearance, and they found that this is all the things they found out. But in total, they found that 70% of the people who applied for forbearance, who had temporary cash flow problems or believed that they were going to get into a temporary cash flow problem, recovered within 6 months. Okay, so we know if we implement HELSIS, we know self-insurance works. Okay, so the solution to the solution to um, avoiding defaults and foreclosures is to provide the temporary cash flow. This is how um, defaults occur. This is based on the model that I had developed in the last 2 years, um, and it's published in my monograph. I published two monographs. One is a critique of Dodd-Frank, forecasting securitized mortgages, mortgage credit and default risk. And the other monograph was real world data modeling in physics, medicine, and credit finance. Okay, so when you look at and this data was based on the CMBS data in the 1990s. A lot of economic data is slow moving, so it gives you a good idea of how things are going to behave in the future. So you have um, this is the sustainable cash flow line, and this orange line is a vertical. It's just two straight lines. This is how the lender's default function works. That means when you hit that lender's 3 months, 90 days delinquent, you get defaulted. But not everybody who hits 3 month delinquent gets foreclosed, because they themselves cure their delinquencies, quickly go back and pay up what's owing, and the bank says, okay, you're fine. And so that line is called um, the sustainable cash flow line. People below this line have a default problem, and people above this line have a have a prepayment, are more likely to prepay, and people below this line are more likely to default. But when you hit this lender's default function, you get the borrower's default function, which peaks at 4 years and slopes all the way down here to 25 years, because it's based on 25-year low mortgages, commercial property mortgages. So what we're doing is there's a lot of stuff in this. I'm just telling you the very simple stuff, the basics, what's important for this. What we're trying to do, what HELSIS does is move potential defaulters from this region out above this purple dashed sustainable cash flow line, so that they become prepayers. They have made their caught up with their payments. They're ready, and if they choose to refinance, they become prepayers. If they choose to sell their property, they also become prepayers. So above this line are people who are prepayers, and below this, in this section here, below that sustainable cash flow line, these are defaulters. And what HELSIS does is to move the defaulters out into the prepayment domain. Okay, so taking into account that homeowners do not want their lose their homes to foreclosure. I mean, have you ever heard a prospective buyer come in and say, look, I want to buy this house because I want to foreclose in 17 months? No, nobody does that, because once people buy their house, they do not want to they don't want to lose it. They do everything possible, rearrange their budget, borrow left, right, and center from friends and family to make their payments. But your income is gone. There's only so much you can do to continue payments. Okay, so the objective of HELSIS is to protect homeowners' wealth by introducing a new bank product that migrates defaulters to prepayers, because that's where we want to be. We want to give people the choice. Either they can refinance or they can resell at a later date, not go down the drain. It's gone, lost forever. And all this will be done within the existing legal framework. And all we need is a very few small changes to how all the pieces of the regulatory framework are put together. Okay, now if we look at, based on the CMBS data, okay, we can see that was the CFPB data is based on homeowners' mortgages. This is data as based on commercial property. We estimate what the number of defaulters can be. Okay, yeah, I'm getting expanded this too small, too big. Let me see. Okay. Okay. Trying to change the screen size. Okay, what we see here is the HELSIS period. Is it to pay 6 months of mortgage payments, 12 months, 18 months, or 24 months? We can see that the minimum number of defaulters that have recovered is between 4%, and maximum down here is 53%. So on average, that's a range of defaulters that the model shows that we can recover. So so another component of the HELSIS is the reverse mortgage. Basically, what reverse mortgage is that for those who do not have income, if you are more than 62 years old and your property mortgage, your mortgage LTV is at most 50%, then you can obtain a reverse mortgage where the bank holds the excess collateral and pays you a monthly stipend. And when that collateral is used, the LTV reaches 100%, it is presumed that you will not live long enough for it to reach 100%. So there are a lot of actuarial work involved in calculating all this. You either have to repay, sell the property, or find somebody else who will buy. Yeah, your only choice is to sell the property, or if you die before the reverse mortgage is fully utilized, then the bank takes ownership and sells the property. That's in the very brief sense what it is. So for HELSIS, we want this reverse mortgage property that cash from equity without income. That means um, when the when the borrower does not have enough income to make those monthly payments, HELSIS reverse mortgage, HELOC reverse mortgage hybrid kicks in and makes that payment on behalf of the borrower. Okay. The other thing is that remember in the earlier slide I showed you that there is a special servicer, where in the case of HELSIS, it acts like a special servicer, except that the special servicing role is migrated from the special servicer to the borrower, because it's the excess collateral that's used to make those payments. So that is another property, a feature of HELSIS. It takes on the role of a special servicer, which does not exist for borrowers. It does exist for um, bondholders when the bonds are tranched, and whether they are more commercial property bonds, commercial property mortgage bonds, or residential mortgage um, bonds. Then the next property that we need is, we recall that I talked about concentration risk. Geithner had a really great solution, wall of money. But we'll take it one more step further. That wall of money is distributed into small bricks. And so each property, like the diagram on the right, each house has a brick of HELSIS. And so with 53 million borrowers, you have 53 million bricks if it's fully implemented as a requirement. Then you have 53 million bricks. And so when some bricks break, the wall is still intact. The distributed wall is intact. You're not going to have a meltdown. You're not going to have large financial companies wrecking the economy, because the wall has been spread, built as a distributed set of bricks. Okay. And the positive side for the banks is that it reduces the bank's capital. Okay, it's not going to happen overnight. I write we write the law, we enact the law, and tomorrow banks' capital requirements are going to go away. No. As people come forward and say, I want HELSIS to protect my mortgage, and as new mortgages come on board with new home purchases, and HELSIS is implemented, eventually HELSIS will reduce the capital requirements, because the empirical data shows that the default rate has reduced by 70%. Home mortgage default rate has reduced by 70%. And commercial mortgage default rate has reduced by 40%, irrespective of whether it's a good time or a bad time. During during the Great Recessions, so many people, even me, a person with 2 master's degrees, one in finance and one in operations research, which is statistics, and a first degree in engineering, electrical engineering. When the crash happened, I was laid off, I lost my income, and I lost my house. What of people with less education and less means? What's going to happen to them when another crash happens? So we have to prepare ahead to protect these people, these borrowers, because when you protect the borrowers, you protect the bank's cash flow. When you protect the bank's cash flow, you protect the banks. When you protect the banks, you protect the bondholders' cash flow. When you protect the bondholders' cash flow, you protect the bondholders. That's the sequence that happens. Okay, so you can see HELSIS is credit enhancement because the bank underwriting converts prospective mortgage borrowers, mortgage prospective borrowers into credit-worthy population. And the mortgage prospect becomes a borrower. And then with HELSIS, as a credit enhancement, that's what it does. It enhances the credit rating of the mortgage in the uh, portfolio of securities used, portfolio of mortgages used to create bonds. So the investment banker now has a HELSIS-backed mortgage, which essentially is credit enhanced, with a pool of mortgages that are essentially equivalent to AAA. Summary. HELSIS is a pre-arranged hybrid HELOC reverse mortgage. And it's primarily there to continue the contractual debt service payments in place of forbearance. You do not have to talk to the bank or the government and say, please, I need a few more days, a few more months. No, this kicks in automatically. And it doesn't work to talk to any of these people. I found out the hard way because nobody can help you. 90 days is 90 days. The only thing that's going to help you as a borrower is HELSIS. So, summing up, the purpose of HELSIS is to provide funds for the cash flow in the event of a delinquency, and the cash proceeds are not accessible to the borrower. It goes to the holder of the debt, either the bank, the originating bank, or eventually through a series of transactions to the bondholder. Timing HELSIS happens when the borrower is delinquent, sufficiently delinquent, or in this case, the borrower has a choice saying, hey, bank, I'm going to be delinquent. Let's activate the HELSIS. And the HELSIS is a HELOC because that's the only way we can structure it so that the borrower only repays what he has drawn down. And the benefit to the borrower is it gives him the time so that he does not lose his wealth. And there are certain things that are possibly interesting from a tax point of view, tax benefits point of view, but that needs to be explained. From the bank's perspective, it has to be senior to the originating loan. It has to be the most senior. Why? So that it always gets paid in the event of a foreclosure, should that happen. And then the rest of the payments, the rest of the sales proceed is due to cover the original mortgage. And it reduces the capital requirements for the banks, um, and it increases their profitability by reducing the charge-offs. And maybe, just maybe, this is the way to handle subprime. But with subprime, let's say with prime, you have 6 months, 12 months, I would say 18 months, because that's what it took me. With subprime, you probably want to go from 12 months to 24 or 36 months. Um, Bondholders, the benefit of bondholders, their cash flow looks practically like AAA. So the key features of the HELSIS structure: pre-arrange original debt service payments, and it should be, HELSIS should be a HELOC, a revolving credit with reverse mortgage properties. It should include property taxes at least 1 year, and depending on the length of the, if it's more than 12 months, uh, payment periods to be covered, then it should include 2 years worth of property taxes, and the bank fees should be included in the HELSIS payment, but only payable to the bank upon the HELSIS being drawn down. Why? Because mortgage insurance for borrowers failed because people felt that they were paying money for nothing. So what we do is we make sure there's no cost to the borrower until the HELSIS is drawn down. Highest debt service seniority, because we want to ensure that whoever takes on, provides the HELSIS as an insurance. Now it's not just an insurance for the borrower, it acts as an insurance for the bondholder as well, as an insurance, um, and the bank, because it acts as an insurance to the bank that they do not lose their loans by giving time, not by making payments, but by giving time. That's what the borrower is asking for. Um, and so we have to set that as the first most senior debt in the investors, in the borrower's mortgages, and then only comes the original mortgage. And you have to exclude the age and LTV restrictions of reverse mortgages, because the homeowner may be a 21-year-old. I've seen 21-year-old homeowners. Um, so in summary, it benefits the borrowers, it benefits consumers and industry, because for the borrower, it's a bridge from one great period of cash flow to the second great period of cash flow, where there is this period in between where the cash flow reliability is horrible. It's a bridge that allows the borrower to make that to cross the bridge, to cross the river of unsustainable cash flow. Banks and lenders benefit because it reduces unproductive capital. Why do we need 9%, 8%, 11% of cash sitting and doing nothing? It lessens the problems, lessens the impact of the bank's internal rating models, um, because if a model is good, it gives you a good idea what's going on. But if it's a model is bad, it gives you a really bad idea of what's going on. And Bank of International Settlements, I've already said that IRB's internal rating-based models are wanting. So we can lessen the exposure to these models. Okay. And homeowners, they avoid losing up to 44% of their investment. Okay. And these are estimates of how much the uh, bank capital requirements will drop to 34% and 58% of what is currently required. And bondholders, it's practically free. No disruptions. Part 5, it's about me. Who am I? Okay. I am the founder of a company called Business AI Models. AI stands for Asymmetric Information Resolution. It's a technique a tool I invented to infer private information from public data. This is a startup based in the Silicon Valley, and it's about company credit risk as a SaaS, software as a service. Okay, and over the last 15 years, I have published 7 technical books. The first 2 I've told you about. The last 2, which was published a month plus ago. This is a critic of Dodd-Frank. It's a monograph. It's only that thin, but it's a very specialized subject. That's why they call monographs. And this one is about real-world modeling. I published 3 books on gravity modification and the foundations of physics using data science, data modeling, not data analysis, to look at the empirical data in physics to examine how can we develop this physics of gravity modification to develop that technology. And I have here, this is based, unsystematic risk is based on my 553-page master's thesis. And I showed that unsystematic risk cannot be fully diversified away. And the last one here, re-engineering, that is my book on strategy and AI models. Okay, to sum up who I am, I'm a specialist in data modeling, which is different from data analysis. I invented the collated distribution, the Wilcoxon regression, the Levi distribution, and asymmetric information resolutions. If you haven't heard of these techniques, you haven't read my books. But I tell you, they make a world of difference to how you see the data. Thank you so much, and have a great week. And please reach out to your congressional representatives and senators to get HELSIS enacted. Thank you.